Right. Hi. Today I've got Jonathan Watts from Simply Finance, who we're going to have a conversation about what mortgage looks like in this era. But Jonathan, before we start, welcome thank you for your time today, and maybe just give us a little bit of a bio about yourself.
Yeah, hi Megan. Thanks for the invitation to be part of this series that you run. A little bit of bio. I've been doing mortgages now for 7 years. Prior to that, I was in senior management roles in the travel industry with House of Travel and Air New Zealand Holidays. And as you can probably imagine, in the last couple of years, I've probably been pretty grateful not to be in the travel industry.
Yes.
With a whole bunch of my colleagues, facing really challenging times. But I've been doing lending now for 7 years, investing in property for over 20. So I had a real passion for property and finance, and hence here's where I am.
Great. Oh, fantastic. Well, in this, we're currently in level 4. It's just the last day in August when we're videoing this. And what are you finding some of those challenges or with COVID in general? Yeah,
it's interesting times in the sense that there's a lot more calm around this lockdown than there was last year when we first experienced what this was all about. And at that time, everyone was in free fall, expecting cataclysmic house price drops, massive unemployment. The banks were scrambling to get communication out of how to handle this thing and what to do to make sure people didn't fall through the floor with their lending. As we know, things changed very quickly, and there was a lot of money looking for a home, and it went straight into the property market. And that's where things just took off from there. Low interest rates and massive amounts of money not being spent overseas, and away it went. Everyone's upgraded their cars, their furniture, their house, bought an investment property, so the money stayed on shore. This time round, there's a lot more calm around it in the sense that the banks are just basically ticking along as they were before. There's no major communications coming out around COVID, in the sense they understand what needs to happen. They will provide assistance for people if they need it. But believe it or not, people are buying houses in lockdown. People are still trying to get finance. Things are still happening. So I think when we come out of this lockdown, the market will continue, and the Reserve Bank will resume its process of wanting to increase interest rates to try and stop the heat in the property market.
Yeah. Oh, that's great. Thank you for that insight with that, and helpful probably if people have a little bit of time to just maybe to get some things in order, get those bits of paperwork required. If they're thinking of needing some money, investing, then it's a great chance to get things sorted.
Personal admin that you don't have time for when you're doing working full time.
Yeah, fantastic. Well, Jonathan, we talked about some tips that you've got for us, and I think we would like to cover off 4 of them today. So, tip number 1: how do we prepare for getting a mortgage, and what are the pitfalls that you see?
Yeah, I'm probably going to answer the first and second tips almost in the same sense here, Megan, because it comes down to I guess being bank ready. So lending is going to get tougher. There's going to be more scrutiny over what you are showing the bank, what the bank wants to know about you. Credit checks are becoming more invasive, so they will know if you're late paying bills essentially down the track, and they will want to know how you're managing your money. So to be ready to get lending these days, you need to have an absolute clean set of bank statements. So no dishonor fees, no unarranged overdrafts, no missed payments on mortgage payments or anything like that, because they're just basically red flags. And what that tells the banks, especially if there's more than one of those in a reasonably short space of time, that you don't know how to manage your money. And when you look at it from your own perspective, if you were going to give your money to somebody, wouldn't you want to make sure that they kind of had a way or knew how to handle their money? And the bank is no different. Yes, they're a business, but they want to make sure that you're going to manage your finances properly, and the money that they're entrusting you with, that you can handle that. So they're looking at how you're spending. So if you've got multiple visits to, say, Sky City, that's probably going to raise some questions. If there's multiple visits to the local liquor shop, and I'm talking one a day or a couple a day, they're going to pick up on things like that, and they're looking for patterns and analysing expenses and wanting to see how you're managing your money. So those are the key things to be prepared for from the start. But we have others that turn up with lots of debt, like lots of credit card debt, personal loan, car loan, student loan, and then they want to go and buy a house. And so the bank's looking at all that debt and going, you simply can't afford to do this at all. So banks have what they call test rates. They'll assess a loan at a certain level of interest, which is way above what you would normally pay, because they want to make sure that you've got some latitude to move if things change. So imagine if the bank lent you everything you could afford at today's interest rate, or the best interest rates today of 2.55, and there was one increase in interest rates, or the car broke down, or your teeth needed doing, you have no fat in the system to spend any more money or find money anywhere else. So they make sure that you've got a lot of gap between what you'll pay for the mortgage and what you might, what the test rate will be, to make sure you've got spare capacity, because we all tend to probably spend a little bit more than what we should. And the banks know human nature. People will cut corners to buy a house and cut down their expenditure, but they'll also splurge at times as well. And they just want to make sure that people are ready and able to borrow this money and handle it well.
Yeah. How far do they generally look back in finances? Like if you're looking ahead, making those changes now, if you say right now, I'm not maybe great, what do I need to change? What sort of time frame would you recommend to make those changes? 6 months, 3 months, a year?
Two answers to that in some way. So they're looking at 3 months transactions, 3 months of bank statements from your main account where income goes in and expenses are paid from. They'll look at that. They'll look at 6 months mortgage statements to see if you make sure you've been paying your mortgage for that 6 month period. And they'll want 3 months credit card statements. They'll look for current loan statements in general, like car loans. They'll want to see that there's been a pattern of payment all the way through. Those car loan statements tend to go for the entire duration of the loan, so you can't really hide anything in there. If you do have some anomaly, shall we say, in your personal bank account that are older than 3 months, then need to wait the 3 months. We'll take you off to another bank. They'll look at those. They may, if there's bigger issues, then obviously we need to know about those and disclose them. But 3 months bank statements, go to a new bank, clean start, and you're all good. If we're doing that with an existing bank, they've got all your history, and they will look at all your history, and they will see whether there's been red flags in the past.
Yeah. Oh, that's fantastic. They're great tips for that. And I guess we've done that, what banks are looking for. So that's what they're looking for in that. Budgeting, that would be a great thing to do, especially in this lockdown situation, is to take a really good look at what you're spending, where you're spending it. Do you have any, we haven't actually talked about this, but do you have a budgeting app you recommend, or a website that people could look at just off the top of your head?
I don't. It's called a spreadsheet. And I think the best thing about a budget is you got to keep it simple, because people can get, you come up with all these great ideas about how you want to do something, but it's the maintenance and the overhead. It's a bit like paying down a mortgage. There's no magic silver bullet to paying down a mortgage. There's a couple of things that you should do that will help. But human nature is we don't want big complex systems that require us to manage to manage processes. So a spreadsheet's good enough for that, definitely.
Great. Yeah, great. All right, that's good. Just stick to basics and do it. Just do it. Yeah. Do it
is the key. And lockdown fatigue. If you give people a complex process to pay down their mortgage, they'll get fatigued with that over time. It's a bit like like lockdown fatigue. We get tired of being locked away. We want to go and do something and splurge. So it comes down to discipline at the end of the day.
Yeah, great there. So we'll say tip number 2, helping your children into a property. This is something which has become a lot more common, especially in our current market in Auckland, I think. But what are your recommendations, or what are you finding with that?
Yeah, there's a couple of things here to consider. Most parents these days of the baby boom generation will have enough equity in their property to be able to either help their children one of two ways: use the equity in their property to help them get a deposit or a loan towards their purchasing their own house, or they will gift them a sum of money. And gifting is very common these days. When you're putting together a deposit for a house for a first-home buyer, money's coming from multiple directions now. It's coming from savings. It's coming from KiwiSaver. It may come from First Home Grant, but those house price caps and income caps are just too low to actually be effective for many people. And there's money coming from gifting, money coming from savings. So it's coming from all over the place these days. And a lot of parents are putting in money, and it literally has to be a gift. When the bank looks at it, it's a letter that we will provide you that basically says we're gifting this money to our son or to our daughter to purchase this house. It doesn't have to be repaid, non-interest bearing, and we'll put no caveats against the property at all. Now, I've had children, many people do that, and at some point down the track, some children actually want to repay their parents that money, and the value of the property has grown to such that they can afford to do that. We borrow the money back out and give it back to the parents. But from a bank's perspective, from day one, it's a gift, and it means that money could go. You know, you're handing it across, and if your children aren't good with finance or get in a bad relationship or things like that, then things can go west. So that would be the first thing. But the most important thing too is get legal advice, and it's really worth talking to a lawyer as to, if we're giving a sum of money to our children or our child, how can we be sure that that money is going to be protected if they end up in a bad relationship, or if things go belly up with the property, or if their jobs fail, all sorts of things. How are we protected? And it's important to have that conversation up front. It's important too that that families do it evenly. So you can't give money to the favourite child and not do it for the rest of the siblings, because that would be unfair, and money divides families. And from our perspective, mortgage advisors, we're not about that. I will have those conversations with the family to explain this is how it needs to be and this is how it should be, because it has to be fair and it has to be even across everyone.
Yes, yeah. And like you say, money and families, it's great, very important to have very open discussions. And
Well, it's about having the hard conversations up front as well, especially if, say, two couples are trying to buy a house together, and you're trying to work, what happens if one dies? What happens if one wants to sell out? What happens if there's a divorce? All those things. You've got to have hard conversations up front. There's no point going into it with rose-tipped glasses and thinking, this is going to be sweet, everything's fine. You need to sort it out up front, because it's a bit like you budget to tell your money where it's going today. You have a will to tell your money where it's going tomorrow, and you get obviously good advice in the between to make sure you know that everything's protected and managed as it should be.
Yeah, fantastic. Thanks for those thoughts. That's really helpful. I'm not in a position to help my children just yet, and thankfully they're not asking. But I think thinking about it and going forward, exactly. I think it will come. And of course, I'm in property management. We've got a lot of investors and also tenants who are looking to invest. So they may not be in a position to buy in the area they want to live in, but looking to invest, and possibly for some of them it's outside of Auckland, or it's just in a different part of Auckland where they want to keep living in the areas that they'd like to live in. So what are some tips for investment property owners or looking to get money for investment property? What are the things you're finding or can recommend?
It's a huge area, this one, in the sense that it's such a hot topic, hot potato at the moment, across media, across every conversation. I think it's an area the government's got wrong, in the sense that they're attacking investors and saying, you're the bad boys, you're driving up property prices, you're causing all sorts of problems in the property market, when in fact investors are providing houses for people to live in. Otherwise they're in motels and emergency accommodation. The government's not able to build enough houses, to provide enough accommodation for everybody. You need to have a balanced approach. And at the moment, they're just trying to crush everyone who's trying to purchase an investment property to provide that as a rental accommodation. So in doing so, they've changed, had a conversation with Reserve Bank, and the Reserve Bank changed the loan-to-value ratio. So you now need 40% deposit on an existing property, in other words, to purchase it as an investment property. However, you only need 20% on a brand new property, and that's where the advantage is now. In terms of purchasing an investment property, you're best to go new. There are the tax changes that are coming in as well, or the proposed tax changes, which is literally breaking the way the tax system is supposed to work. It's a complete anomaly into how that system is supposed to be functioning. So whether it's going to make it through, I really don't know. They're still in negotiation, still in conversation. Truthfully, I don't think are very happy about it. And again, it's a complex thing. So whether they actually bring in the taking away the ability to deduct interest on an investment property, don't know. It's supposed to be in around October this year, I believe, and obviously lockdowns and the difficulty of what they're trying to achieve is not actually coming out the other side. So purchasing an investment property, I think it's still a good thing to do. Property is still a good asset to be buying into. It's something tangible you can wrap your arms around. You can see it, it's there. Unlike the share market where you're trusting someone else with your money pretty much, and that they're going to make good decisions and make that company grow. So again, you can use equity in your own house. If you've got a good owner-occupied property that has some good equity in it, you can take some money out of that, use that as a deposit on the next property. The banks will take some of the rental income and use that towards debt servicing. And you'll be surprised, we took our first step into investment properties 20 years ago, or over 20 years ago, and it was a scary, scary thing for them. To buy that first one was a big step. And once we understood the concept, we started to flow from there and actually understood that it's not a bad way to actually prepare for your future by owning multiple properties if you can. So I guess those are some thoughts. You either would go with a bank primarily if you can, otherwise we'll look to a non-bank lender. But again, with this emphasis on dumbing down the investment market and stopping investors purchasing to a large degree, even non-bank lenders are now under stricter controls than they were before. They used to be the better go-to guys if the bank wasn't prepared to look at it, but even they have had their wings clipped by outside forces to control how much they can now lend in the investment market. But I guess to summarise it all, Megan, people are still buying investment property. It's still an opportunity. Brand new property is probably the best one to go for right now because you'll get the best tax deductibility and don't need as much deposit. Buying an existing investment property or an existing property, a few more challenges, and you'll need to be prepared to probably not make as much out of it as you might down the track. And I guess one other shout out here, when you're buying an investment property, there's a few things you need to consider. And one of them really is, and I'm not saying this just because I know what you do, but I've done this in the past. I've managed my own investment properties and made an absolute mess of it. And I now understand and put all my properties with a property manager because I don't want that phone call at 5:30 on a Saturday when I'm about to go out for dinner or something like that. I don't want to have to be chasing the unpaid rent. And I have been in those positions where I had thousands of dollars owed to me because I was trying to help the person. And I didn't actually make the separation between this is actually a business and I need to treat it like a business as opposed to something else.
Yeah. Well, obviously, I echo that, but primarily because it's a business, and you want a specialist on board in that. Just know, I wouldn't think about doing my own mortgage financing. I could just go to the bank and do it, but I wouldn't think of that. And it's just the money, obviously the time involved, the challenges, and especially in this new era. I believe we are in a new era of investment and and it's just getting specialists on board, which includes your mortgage broker, your accountant, your property manager, and a real estate agent. Really, that, you know, having a team that give you that, and what advice is just imperative to build that portfolio. And
very true. And I guess that leads to a question: why would you use a mortgage advisor? Why would you want to have a conversation with someone like me when you could go to the bank and chat to them? And things have changed so much in finance these days. Branches are being closed with banks. They're actually pulling staff out of banks, so there's not a lot of what they call approved lenders in branches now that can actually approve lending. So yeah, you could do this yourself, but if you wanted to know what, say, ANZ were doing in Westpac and TSB, you'd have to go to each of those banks, fill out their application forms, have that same conversation, give them the same documents. Whereas with the mortgage advisor, you do it once. With us, we see all the deals all the time going through all the banks. We know where the money is. We know what's on offer. We know where the right rates are, and we'll give you more advice than a person behind the bank counter will. And we'll be with you for life. So I mean, part of our mantra at Simply Finance is we want to be your property finance partner for life. We're looking for long-term relationships, not a drop and run and see you later.
Yeah, fantastic. Well, fantastic, Jonathan. I really appreciate that, your time today to invest in us and upskilling us on that. And I'm sure if anyone's got any conversations, I will do my best to edit with the website so that they can get in touch if they want to would like to have a continued conversation about what that could look like for them. So I'll share that information with these videos and do that.
That's great, Megan. Thanks for